Hello, everybody, and welcome back. In recent years, many investors have mainly looked at US big tech such as Apple, Amazon, or Google. But there are some reasons to look at the second tier as well. Today, I talk to Michele Ward, portfolio specialist for US smaller companies, equity strategies from Rowe Price about opportunities in US small caps in the current economic cycle. A warm welcome to Michele.
Thank you very much. Great to be here.
Michele, how have US small caps done in the complex environment of rapidly rising costs of capital, high inflation, and weak growth?
If you look back at the last several years, the answer is remarkably well. The need that you just went through are a lot of challenges that many of these companies faced. And I think they faced them incredibly skillfully. They have managed to hold value in a time when most of the market is focused on challenges that we've just been through: COVID, the recovery from COVID, supply chain disruptions. All of these factors required these companies to be incredibly nimble. And so the bottom line is very well. That said, there are divergences underneath the surface that are important to know. I think this is an area of the market that has always been one that favors stock picking, selecting the best of the best. And I think some of the tensions we're seeing in the market today make that even more important. So I think one of the things that as we talk, we will want to discern, are we talking about the small cap market as a whole or the selected companies within that space that provide the best potential return for investors?
The discussion of small caps being undervalued relative to large caps is as old as the stock markets themselves. So, how significant is the imbalance today, and what could be triggering a valuation change?
There have been times when small caps have gotten expensive relative to large caps. 2014 or so was not that far back in the rearview mirror. But as we sit today, we're more at a once in a generation low in terms of small cap stocks' relative cheapness compared to large caps. The last two times that small cap stocks were as cheap as they are today were in the turn of the century, 1999, 2000, the dot-com boom and bust that many investors today remember. And then you have to go back to 1973, which is much hazier in memory, but it was another time where small cap stocks got as cheap as they are today. So that doesn't come around very often. Valuation itself is never a perfect signaling tool in the short term, but it's often a really good signaling tool when you think out 5 or 10 years. So this is a great opportunity for investors to consider taking an exposure to the US small cap market if their time horizons are long. It's not a trade, it's an investment. What would cause that to change? I think there are a number of things that favor small caps as we think out, particularly to the environment of 2024, 2025, 2026. So I imagine we will get into a number of those as we move on in our conversation. But I think the biggest trigger is likely to be as we turn into 2024 and start to think about relative earnings growth.
Global tech has been the US stock market's powerhouse over the past few years. In this environment, why should investors skip the party and go for small caps?
Well, I think what we saw last week in Tesla's shares responding to its earnings report is a good example of the high expectations that are embedded in some of these global tech powerhouses. They're priced for perfection. And when that kind of perfection isn't achieved, you can see these stocks stumble. They have driven the S&P 500's returns year to date, and if they don't continue to deliver against those high expectations, that's going to be a challenge for large cap stocks in general. So why look elsewhere? Well, the potential risk reward opportunity is much more reasonable in the small cap space. I think small cap stocks embed a lot of fear and concern about recession, about geopolitics, about interest rates, about inflation. They're baked into the expectations that are there today. So as long as small cap stocks deliver or continue as they have in many of the quarters we've seen in the recent 12-month period to outperform those expectations, I think the difference in the return risk profile will become apparent to the market.
Since the beginning of the year, US small caps have experienced an unexpected rally. So was this a technical reaction to the weak year 2022 or the start of a longer term trend?
I see it as the start of a longer term trend. Coming off the rally, the bottom in June of 2022, small cap stocks really started to outperform then. There was a bit of a pause in March as the bank's issue started to materialize and create concern and fear in investors' minds. At exactly the same time, good news about AI took the market's imagination back to the large cap universe. We saw small cap stocks again start to rally in the summer months, and only to be seen to be a little bit more concerned with the rising geopolitical risks that we're seeing today in headlines of papers around the globe. But as I said a few minutes ago, there are probably more things supportive of small cap stocks than there are of concern. And so I expect that rally to continue. What we've seen in the past, coming out of 73, out of 99, is that these rallies can last for 3, 5, 10 years, not just a trade, but a long-term period of outperformance.
The outlook for the US economy is not rosy right now. So we've seen high inflation rates, rising interest rates, cost of capital have gone up. So what makes you confident about US equities and small caps in particular?
I think the consensus among economists has shifted away from the probability of recession to one more of a soft landing. And in his remarks last week, Jay Powell suggested that he and the Fed view that probability as quite likely as well, signaling that they may be approaching a pause. And that's historically been a really good signal for when small caps begin their rally. I think one of the things that gets overlooked is the general resiliency of the economy, the creativity that we bring to the table. But there's also a lot of supporting tailwinds as well. Companies themselves started to reshore manufacturing in 2022. The supply chain issues, the rising geopolitical risks that they saw made them start to take their matters into their own hands. The initiatives that the legislature in Washington has passed, the IIJA, the IRA, the CHIPS Act, represent another tailwind that is likely to kick in starting in 2024 and has funding through the coming decade as well. Consumers, at least at the high end of the market where a lot of the spending happens, are still finding themselves in good financial shape. So there's a lot more positives going in favor of the US economy for the next couple of years than there are additional or incremental negatives.
In which sectors and companies do you prefer to invest with your small cap strategy in the current market phase?
Our strategy is intended to provide investors with exposure not just to the US smaller companies equity market, but to the US economy. And so as a result, we invest in all sectors. It's a broadly diversified portfolio with approximately 175 holdings. So we're present in every sector, in almost every industry. There are a handful of small industries that we don't see as particularly attractive, but we're broadly based today. There are particularly good opportunities for us in technology, in industrials, in energy, which is one of the areas where we've been growing our exposure, going from an underweight to an equal weight, as the fundamental cost of extracting energy out of the ground has shifted from getting cheaper every day to getting more expensive. And that becomes a greater opportunity for us. But our team of 50 analysts finds ideas in virtually every sector, virtually every week.
So let's have a look into the crystal ball. You already mentioned technology and energy. So which small caps should outperform their large cap counterparts over the next 12 months?
So the companies that we're looking for in any industry, but in particular in areas that you just mentioned, industrials, technology, energy, are ones that have pricing power. With all of the things that we've been discussing, geopolitical issues, inflation, interest rates, companies that have the wherewithal to be leaders in their industry, to take price and hold it in downturns, are important sources of long-term value for investors. And so that's what we look for, not a cookie cutter of a particular defined view of what a company should look like, but rather trying to get to know each company and its long-term strategy so we can find individual companies that can take price. So, for example, one of our largest holdings is Ingersoll Rand, and they have been successful in taking price for a long term. We've looked at their success in the compressor industry over a 40-year period, and they have been able to successfully take price in a variety of economic environments and hold it even when times get tough. Companies like that we're trying to find in every area of the portfolio.
So this was Michele Ward from Rowe Price. Thank you very much, Michele, for being with me today and sharing your insights on US small caps.
Thank you so much for having me.